Recording in progress.
Good afternoon, everyone. I just want to let you know that we are actually running late, just a couple of minutes though, but I want to welcome you all to Tax Resolution Help Center. My name is May. I will be hosting today's session and introducing today's speaker. I will also be coordinating the Q&A chat session at the end of this session. I want to congratulate all of you for taking steps to deal with your taxes. Taxes from all sources, including income tax, payroll tax, property tax, excise tax, and sales tax, s- represent a 35% to 60% reduction in your personal savings and wealth. As you probably know, those with 1% of wealth in this country have experts to help them pay a small percent of tax. Our goal is to help you reduce how much you pay in tax by educating and informing you on ways to reduce past, present, and future tax expenses. We think you are entitled to live a happier, healthier life by keeping more of what you earn and getting the taxman off your back. Our goal is to provide good information with the opportunity to ask questions that are important to you. Presentation will last about 20 minutes plus 20 to 30 minutes for you to ask questions by chat. I will select the questions and present them to today's expert. If you wish, you can include your first name and your state. That would be great. Other than that information, your identity is not mentioned. The information you are receiving in this session is not specific tax advice. If you want specific tax advice for your situation, you are free to contact today's expert or any of our tax experts at Tax Resolution Help Center. As you know, these group sessions are included in your do it yourself membership fee of $20 per month. If you are not yet a member, please sign up today. We need your financial support. And to better understand what might be on your mind during the session, I might ask some polling questions to ask you. I will then finish with a 5-minute wrap up. Also, a survey will be sent looking for your feedback. And finally, this session will be recorded. The topic for today's session is taxes for the self employed, 10 tips to minimize tax expense. And the tax expert for today's session is Callie Coughlin. Kelly is a CPA, the Chief Executive of Everyday CPA, and founder of Tax Resolution Help Center. Kelly has been a CPA for over 20 years and has helped many self employed business owners better manage their tax expenses by planning, company formation, and business strategy. Kelly loves to help small and medium sized business owners with past tax debt prepare tax returns that tax full advantage of tax laws and plan for the future. With that said, introducing Kelly Cullen.
Hello, Maylene. Thanks for the introduction. I'm Kelly Coughlin. You know that. Others might not. Thank you for that nice introduction. And it's a busy season for us here. And it's tax season for the self employed isn't a welcomed event. Um, Self employed people don't typically don't get refunds unless they have kids. They get child tax credits. Um, that's their so tax season isn't their favorite time of year. But I love to help them because self-employed people, small businesses make the economy work, and I like to help them keep working and keep more of what they make, and that's what most of us here at Tax Resolution Help Center in our own practices. That's what we do. Here's my contact information if you wish. Here's what the IRS looks like when you is trying to collect on taxes. There's the mean guy. There's the bear. There's the gun held to your head. Here's the taxpayer in the shower. I'll let you recognize what that is implying. Here's what happens when you have tax debt. Spouses don't talk, they blame each other. We like to prevent all this. There are 5 types of taxes that self-employed people have to deal with: sales tax, property tax, excise tax, income tax at state and federal level, and then self-employment tax. We're going to focus primarily in this session on self-employment tax. It can be 15.3%. People wonder why that number is so big. In a W-2 world where you're an employee and your employer pays half of that 15.3 and you pay the other half. When you're self-employed, you are both the employee and the employer. So you pay half of it as the employer and you pay half of it as the self-employed employee. That's why it's double. Then on top of that, you have income tax. And of course, all throughout the year, you have sales tax on the goods and services that you purchase, you have property taxes, whether it be real estate or others. Then you have excise tax. So you get hit quite a bit on taxes, and you need it. You need help. And tax season is kind of the time that focuses on that. I'm just going to give a quick overview of this. The goal in both of these things, in income tax and self-employment tax, some of you may be familiar with your Schedule C. Line 31 is the key number there. That's the amount of net income from that Schedule C. That number is what's subject to self-employment tax. And then that number feeds your 1040, which is then subject to income tax. So line 31, Schedule C, is subject to that 15.3. You want to keep that number low. And the only way you keep that number low is by minimizing your profit. Now, nobody is in business to of the assets that you purchase, the bigger ticket items, you get the tax deduction not based on how much of your cash did you put into it, but cash plus how much of the bank's money or the seller's money you put into it in terms of a loan. So you get that potentially that full deduction, or at least that would be available for some sort of tax strategy. Typically, that's going to be a depreciation expense. And then you look at different forms of depreciation that are out there to help you get accelerate that depreciation. So that's what you get with that. So depreciation will help you reduce that keep that line 31 Schedule C low, and then that feeds your income tax, which will help you keep that 1040 line 15 low, which is your taxable income. So that's how that would work for the relationship between self-employment tax and income tax. They're certainly, if one is higher, the other is going to be higher. If self-employment income is higher, self taxable income is going to be higher. So here's a quick tips that I go over with your Schedule C. Make sure that you don't over-report your revenue. We did a session last night on QuickBooks, and some people use QuickBooks and some people don't use QuickBooks very effectively. And they end up, believe it or not, over-reporting revenue because they haven't done the. I don't want to get into how that happens, but it's kind of fairly easy to over-report income. I like to recommend that people go through and look at your bank deposits in your bank just to reconcile, make sure that those deposits are total up the deposits, and then you'll see some of those deposits might be capital, some of them might be a loan. You don't pay tax on your own capital. You don't pay tax on loans. You don't pay tax on money that your grandmother gave you, right? If that happened to go into your business. So make sure you're not over-reporting on income. That would be number one. And then on expense, make sure that you go through all of your credit card statements, look for cash withdrawals. Some people think that, oh, it's a cash thing. I didn't get a receipt. Well, it's a IRS is, believe it or not, is in part an honor system. So if you have cash withdrawals that you've made, I remember when I used to go to New York a bit, it seemed I would always take out like $500 cash because it seemed like in New York you always needed cash. Everybody wanted money, tips here and there. Taxi drivers back in the day when we took taxis, doormen needed tips. You could get ahead of lines and you needed to come with cash. So I never got receipts for that stuff. But what I would do is go look at my bank statement, make a copy of that, show $500 and show trip to New York for business, whatever it was, right? And then that's the receipt. Even if you can't come up with that, put a note in the file saying, yeah, I pulled out $500, the best of my recollection. Make a reasonable effort. It's always worth it. Your challenge, if you ever get challenged, then it's the IRS would say if it were like a $50,000 cash expense and you didn't have any receipt, that would get challenged, and you would probably lose that one unless you had a really good reason for why you had a $50,000 cash expense without a receipt. That doesn't make a whole lot of sense. So kind of pass the smell test on some of that. But bits and pieces, small amounts here and there, and even if they add up to a large amount, don't be afraid to take them as business expenses. Remember mixed use on cell phone, mixed use, cell phone, internet, automobile, travel, supplies. Those are the ones that I typically see that can be mixed in terms of business and personal. Do a reasonable allocation of those. If you have a family of 5 and they're all on your cell phone plan, you probably have a lower business use or a higher percentage personal use. So don't be overly aggressive with that. If you're a single guy and work is your life and that's what you do, I'm not talking about me, I don't think, but close. I use my cell phone nearly 90% for business. I'm not a big one to be yakking on the phone, make personal calls, that kind of stuff. So that's how I use it. So use a reasonable effort to allocate those. I always like to recommend that people download bank statements and the credit card statements. That's the PDF version. And very important here, download the CSV or XLS file of the transactions for the year. There's so many cool things that you can do with that CSV or that Excel file. You can pretty much reconstruct your own income statement off of that. We love to help people do that haven't made the QuickBooks type purchase. Some people that really don't need to make a accounting system purchase. If you're not doing invoices, and I do a lot of truckers, and so they pay credit cards or debit cards on the road. They don't invoice anybody. Doesn't make a lot of sense for them to be maintaining a QuickBooks thing. So you can use your bank account as a way to get the transaction detail throughout the year. Remember on itemized deductions that you use your itemized deductions can be used on a Schedule C or a Schedule E, and they could be used on a Schedule A. That's kind of mortgage interest and property taxes, property insurance. If you don't have a business for that property, or for that mortgage interest payment or for that property tax, then you wouldn't allocate any of it to Schedule C or Schedule E. Schedule C if it's operating business, Schedule E is if there's a rental activity. So be aware, you're always better off having, always, I should say, most of the time you're better off having those itemized deductions on your Schedule C or Schedule E versus your Schedule A. Sometimes it doesn't make any difference, but again, if you have a business and you're using that asset, that property, that real estate, for instance, then you'll want to put it on your Schedule C and your E, and maybe it's 50-50. Let's say it's a duplex, you got half and half. Here's a final point I'd like to make is make sure if you have any free cash flow and you're making retirement contributions, don't do it in your IRA. Do it in the Schedule C. Do it in an SEP. IRAs are after self-employment tax is calculated, so make sure it's sometimes they call them an SEP IRA SEP or something. So make sure you get it before the net profit, or I'll put it this way, make sure it's included in the calculation of your net profit on your Schedule C. You want it to be kind of above that line, that expense line, or included in that expense line. So you get, not only you get a downstream tax savings on your taxable income, but also on the self-employment taxes. So it's very important to do that. Here's another tip. Active, I'll probably do a session just on this ACL PPE. This is my little thing here. Active, make sure you have if it's an active business and you're losing money in it, try to make sure that goes on your Schedule C, because that will reduce your taxable income there. If it's the loss, there'd be no self-employment tax on that. And PPE means if it's a profit, it's passive, and put it on your Schedule E. There's no self-employment tax there. So when you're making money, you'd rather have no self-employment tax. If you're losing money, it doesn't make any difference on self-employment, you don't pay, but it will reduce your other taxable income there. So I think that's all I have. And unless we have a question, I'll put a quick plug in here. Don't forget to join Tax Resolution Help Center. Less than $20 a month. We can use your support so we can keep this going and keep growing and doing more sessions. And with that said, I have time for one question, Maylene, if we have that. Do we have anything?
Yes, we do have one question here. The question is, this is from Christina, and she's asking if, do I have to make quarterly tax estimates?
You might have to, Christina. It depends on if it's your first year. I wouldn't get too hung up on that. I kind of recommend that if you keep track of if you're making money, then I kind of recommend that you make a quarterly, you at least budget for it for like 15 to 20%. It's really important, I think, to at least budget for that. Whether you send the money to the IRS is another question, but you should plan on budgeting if you're making money, and if you think you're going to make money for the year. The IRS doesn't tax you quarter by quarter. It's the entire year. So if you're having a great quarter and you don't think it's going to continue, then you don't need to send any money in, right? Or let's say you made $100,000 in quarter 1 and 2, and you're going to lose $100,000 in quarter 3 and 4, right? Break even. You don't want to send any tax money in there. That wouldn't make any sense. If you do, and you've overpaid, you get a refund. That's how self-employed people get refunds. So it depends on your facts and circumstances. It's a very good question, but certainly in your first year, I wouldn't worry about making estimates. I would focus on budgeting though, so you don't get some tax bill that you haven't budgeted for. That's it. Is that the only question we have? So I can get back to work. I've had a stressful day, Maylene. My internet didn't work all day, and I was not happy. But now I'm happy because you got this ready to go, and hopefully I've shared some information.
Yes, that's actually our last question for today. Thank you also, Kelly, for still showing up for our session. We truly appreciate you giving us time and your knowledge
Okay.
and giving us a real life examples. Anything else you
Okay.
want to add?
Nope. That's it. I'm going to roll. Thank you for putting this on. Thanks.
All right. Bye. Thank you so much. All right,
Bye.
everyone. I want also to thank you for taking your time and also attending in our session. Our commitment is to help you reduce your taxes and increase your wealth. We do it with the TriTax method of DIY, do it yourself, DIT, do it together, and DIA, do it all. Three methods, one solution. Reduce your stress from no IRS or state tax debt and a happier, healthier life. If you are not yet a member, please join for less than $20 per month. We need your support to continue to offer more of these sessions. Since it is now tax season, we have many sessions to help you do a better job of doing your taxes yourself. And of course, if you want help, we have a team of experts who can do your tax return for you. Please check our website at taxresolutionhelpcenter.com and please join as a member today for $19.95 per month. And again, thank you all for attending and have a wonderful day.